Okay, what we're going to talk about today is the American Taxpayer Relief Act of 2012. Now, if you remember, right around Christmas time, there was this big hullabaloo about the fiscal cliff, and all of the Bush-era tax cuts were expiring, and everybody's tax rates were going to go up, and everyone was scared and paranoid, and Congress finally got their act together, and they agreed to some legislation that President Obama signed on January 2nd, 2013. So that's what we're going to talk about, is all the tax changes that came about as the fiscal cliff was settled. And basically, what we'll focus on here are just some of the individual provisions, things that are of most interest to the club. The bill is enormous, has tons of business-related tax breaks and energy-related tax credits, and I won't focus so much on those, but mostly just the individual items. Basically what we'll talk about today is that the fiscal cliff legislation extended a lot of the Bush-era tax cuts for most people except for the wealthy. So that's kind of the basic summary of it, and we'll go through some details. The first importance is just the general tax rates on ordinary income. And right now we have, we had brackets at the 10%, 15%, 25%, 28%, and the 33% brackets. Those brackets were all extended, and had they not been extended, they would have increased for all taxpayers. And the only bracket that was increased as a result of the American Taxpayer Relief Act was that the 35% bracket, which is the top bracket, went up to 39.6%. That was historically what the rate had been under President Clinton. And this new bracket hits for taxpayers at $450,000 of adjusted gross income for married joint filers and $400,000 for single filers. So that's how the income tax brackets changed. As well, there's a new net investment income tax, which actually came in under a prior piece of legislation, but which is effective on January 1, 2013. Sometimes people call it the Obamacare tax. The tax professionals call it the net investment income tax. And this is a new 3.8% income tax on investment income, such as interest, dividends, rents, royalties, and capital gains. And that's 3.8% on top of your ordinary brackets. And this starts at $200,000 of income for a single filer and $250,000 of income for a married filing joint filer. And one item to note is that municipal bond interest is not included in this new net investment income tax calculation. So if for wealthy taxpayers, municipal bonds are exempt from income tax, and they're also exempt from this new net investment income tax that's being imposed, so they become extra advantaged. Another feature of the legislation addressed the corporate qualified dividends and long-term capital gains. If you remember, previously we had a special rate for dividends that taxpayers received, and that was 15%. And the new legislation increases that to 20% for taxpayers who are in this new high bracket. Everybody else still can enjoy the lower tax rate on dividends of 15%. However, as I noted previously, there is this new net investment income tax. So that will actually go on top of the 15%. So dividends may in fact be 18.8% or 23.8% depending on your income bracket. So if you're at $200,000 of income for a single person, actually you'll have a surcharge on top of the 15% rate. And then if you're in the new 39% bracket, you'll have that 3.8% on top of the 39.6, bringing you up to 23.8%. So 20% plus to 3.8%. Similarly, for long-term capital gains, which have historically been advantaged, so this is for the sale of capital assets held for more than a year and a day, you get a 15% tax rate, and that was retained and extended under the legislation, except for taxpayers in the top bracket. That was increased now to 20% for those top tax bracket payers for capital gains. And then if you add in this new net investment income tax rate, it's 18.8% for the 15% payers and 23.8% for the top tax bracket payers.
Bob?
Yes?
Brings up a question, I guess, in my mind. There's long-term capital gains. Are there any changes to the rates on the stuff that you buy and sell within that year?
Those are short-term capital gains, and short-term capital gains are just taxed as ordinary income. So to the extent that the ordinary brackets were retained for most taxpayers, there's no change. If you're in that higher bracket, then it'll be taxed at a higher rate. Return of the vampires, as they call them. There's a couple of provisions that had been in the tax code in the 90s and were repealed by the Economic Growth Tax Reconciliation Act, which is called the Bush Tax Cuts. And under that prior legislation, itemized deductions used to be phased out when your income increased. The Bush tax bill threw that out, and as well, personal exemptions were phased out. That was thrown out by the Bush tax bill. This new legislation brings back those provisions. So the itemized deduction phase out, of course, everyone knows you can take various kinds of itemized deductions against your income. Charitable deductions, mortgage interest, state income tax deductions, etc. Well, what this provision does is it says that once your income hits $300,000 for a married filer, $200,000 and $250,000 for a single person, these deductions get phased out over time so that you no longer get to take your itemized deductions. So this brings back that provision. A lot of charities were concerned about this provision because obviously it makes charitable deductions less attractive to higher income taxpayers if they can't deduct it. So it's really, we'll see whether or not how that really affects charities or not, this itemized deduction phase out. Also as well, everyone's entitled to a personal exemption. It's $3,900 a person in 2013. So what happens is once your income hits $300,000 for married filing joint, $250,000 for a single, this personal exemption that you get phases out and goes away. And effectively it can be zeroed out once you reach a certain amount of income. So those provisions return now, so it's another disadvantage, for the higher income taxpayers. Not only have the rates gone up, but now they lose their itemized deductions and personal exemptions over time as their income increases. The alternative minimum tax, and I won't spend a whole lot of time discussing exactly what it is, but it's a pretty complicated provision that is intended to make sure that people with a lot of deductions pay some income tax. And what had happened is that this was put in place in the 1970s, and they never fixed the exemptions for it. And so it gradually started to impact more and more middle-class taxpayers. And every year they would have to pass a patch to fix the alternative minimum tax, or it would apply to a lot of people. So what they finally said is, okay, enough is enough. We're not going to do this annual patch year after year. And they made some permanent exemptions for the alternative minimum tax. And it's $80,800 for married and $51,900 for singles. And that doesn't necessarily mean that if you're over that limit, you're going to be paying the alternative minimum tax. It's a pretty complicated calculation, but essentially those limits will really exclude 95% of Americans from having to pay the alternative minimum tax, and that will be adjusted going forward. So we don't run into a situation 20 years from now with inflation whereby we have to go back to this annual patch like we were doing. So fortunately, the alternative minimum tax was fixed for most Americans. There's tons of tax credits and other goodies that are in the tax code, and a lot of them were extended, so I'll just kind of go through and talk about some of them. For example, the child tax credit. If you have a child who's 18 or under, you get a $1,000 credit per child, and that phases out if you have income over $110,000. If it hadn't been fixed, that credit would have expired and gone back to a $500 credit. So that was extended at the $1,000 level. The earned income tax credit was extended with some simplified definitions and some expanded scope. The American Opportunities Tax Credit, which is an education tax credit, that was extended under the legislation. So effectively, you can get a $2,500 tax credit per student. That continues. Here's one that everyone will be very happy to learn about. This is our state sales tax deduction. That was extended, at least for this prior year in 2012. So when you file your return this year, you will be able to deduct your state sales tax. And in 2013, so this year, so the returns will file next year at this time, we can still claim the state sales tax deduction. After that, it's up in the air. So if you remember, what this provision says is you can basically choose to deduct your sales tax or your state income tax. Well, because we don't have a state income tax, most people in Washington are going to choose to deduct their sales tax. So that's a good benefit for us for at least this past year, and the coming year. And if you remember, the way this works is you can keep all your receipts if you want to and add them up and put that on as an itemized deduction. Or if you don't keep all your receipts, there's basically kind of a basic deduction depending on your income that you can take, and there's a little calculator in a table you can look at, and then you can add in major purchases, like a purchase of a car or a boat or something like that, and deduct the sales tax on those items. So that's good news for people in Washington. Another item, tax-free donations of individual retirement accounts, if you're charitably inclined to charities. Again, we have a short window on that, some uncertainty after 2013. A bunch of other miscellaneous provisions people might be interested in. If you have mortgage insurance, typically this affects younger people that have larger mortgage balances with not a lot of equity on their property. You can be required to have mortgage insurance to make sure you get your mortgages paid, and then if it's not, the insurance company pays your payments. You can deduct that as interest, the premiums on mortgage insurance. Cancellation indebtedness is excluded. So if you have a personal residence and you're foreclosed on, you can exclude any debt forgiveness. This was a provision that was going to expire but is extended for 2013. This helps people that are either having their home being sold in a short sale or foreclosed on. You don't have insult to injury by having a big tax bill in addition to losing your house. So there's one more year on that income exclusion. And then student loan interest deduction was permanently extended. So if you have student loans you're still paying off, most students can, depending on your income, deduct the interest on those student loans. More goodies keep coming. Dependent care credit. So if you have a child and you're working, the credit was extended, made permanent. $3,000 per child, $6,000 for more than one child to pay for extended care. The adoption credit, if you adopt a child, you can get a credit for $10,000. If an employer provides you education money to go to school, you can exclude that from your income. That was made permanent. And educational savings accounts, which are like IRAs for people saving for their kids' education, that was made permanent at a $2,000 level. And a little bit of bad news. It's not all goodies. This is the payroll tax, and maybe some of you might have heard about this. But for the past couple of years, employees have been receiving a 2% benefit for the past couple of years. That was not extended. So starting this past January, if you've been working, you might have noticed your paycheck might have gone down a little bit because the employee share of Medicare is 6.2%, and it had been lowered to 4.2%, and so that went back up to 6.2% that your employer was taking out of your check. And if you're self-employed, the rate had been 10.4%. It's going back to 12.4%. So make sure if you're self-employed that you're paying estimated taxes, that you're figuring that you're paying an extra 2% on your self-employment tax and you pay your quarterlies properly. So that's not a good thing, but this is a very expensive item. Even though we're talking about 2%, you're talking about something that impacts hundreds of millions of Americans who are working, and they really just couldn't afford it anymore. So it's a little bit of bad news there. Some business-related items. As I said, there's tons of business stuff that'll probably bore everybody, so I'm just focusing on some of the really big ones for businesses. Is that it was extended, this work opportunity credit. So if you hire employees that are veterans or long-term unemployed individuals, there's an opportunity as a business to get a tax credit of $6,000 for new hires. There's some depreciation items that were extended for 2013 only. They call bonus depreciation. If you buy new equipment, you can get a 50% bonus depreciation of your purchase. And Section 179, which allows you to purchase certain types of equipment and get an immediate write-off, that was extended for $500,000 worth of purchases on certain items. So those were, the reason why, of course, they do that is depreciation. If there's some benefits, people will, businesses will go out and buy equipment. And so they want to encourage people to continue, businesses to continue buying business equipment and stimulating the economy. So that was the theory on why they were extended for 2013. And then lastly, I just want to spend a couple minutes talking about another type of tax, that the estate and gift tax. And this was another piece of the fiscal cliff legislation that was very controversial and a lot of concern about what was going to happen to it. And it was resolved, fortunately, as part of the legislation. The estate tax. This is the tax, of course, that an estate pays based on its fair market value when someone passes away. The exemption was going to revert back to $1 million in 2013 if it hadn't been fixed. And this was changed and retained at what the level had been last year, which was $5 million, increased for inflation. So it's actually $5,250,000 is what the estate tax exemption in 2013 is. It is now permanent, so we don't have any of these sunset issues going forward. Of course, Congress can always change their mind, but in the legislation, there's no automatic sunset on the estate tax, adjusted for inflation going forward. I will point out that the Washington state estate tax is still $2 million. So we have this federal regime where you pay a federal estate tax with a $5 million level, and the tax rate's 40%, up from 35%. And we also have a Washington estate tax that kicks in at a $2 million level. And the tax rate there varies between 10 and 20%, depending on the size of the estate. And then we also have, in addition to the estate tax, a gift tax. Because, of course, without a gift tax, people would just give away all their money before they died, and then you wouldn't have a large estate. So you could get out of the estate tax. So Congress is pretty smart. You have to have a gift tax to protect the estate tax. So we still have the gift tax. The annual exclusion is $14,000. So that was increased slightly. So what the annual exclusion is the amount of money that you can give per person, per donee every year, and not have to worry about filing any returns or claiming the exemption. It had been $10,000 and it kind of been creeping up, and it's now $14,000. And then, of course, in addition to the annual exclusion, you can always give away your $5.25 million anytime you want. You just won't have it when you die. So that there is a lifetime exclusion. One time, use it or lose it, $5,250,000. And then lastly, I will point out that Washington State does not have a gift tax. So from a planning strategy, wealthy people, if things aren't going well for you physically, there are some gifting opportunities to help you minimize your Washington estate tax, because there is no gift tax.
Bob,
Yes?
there's still the remainder for the rollover from one spouse to the other of the $5 million deduction.
Yes, we'll talk about that. That's my next and last slide, which is called portability. And what this was a relatively new piece of legislation a couple years ago, was added to the tax code, which basically says that if you're married and one spouse dies, upon the death of a second spouse, you can basically use the exemption from your spouse who had passed away, so that effectively you could pass not just $5,250,000, but 10 million plus. And that's called the portability, meaning you can pass on or use your spouse's exemption. So that is still in the code. That was extended. It was made permanent. It was a temporary item. So that certainly does help. Now, I will say that if you're a high income or a taxpayer that has a lot of assets, I wouldn't just rely on that alone. There's other planning that you really should be doing, and that's the creation of what's called a bypass trust or credit shelter type trust. I still recommend those even for wealthy taxpayers. This portability, I think, is mostly for people that didn't do any planning, didn't go see an estate planning attorney, and it kind of bails people out, who might have fallen into this trap for the unwary. And as well, portability only applies for federal tax. So if you're a Washington resident, you also need to do the appropriate planning, because this isn't going to help you for the Washington estate tax. So if, for example, if you had a husband and wife and one spouse passes away, and now the second spouse passes away, you don't get to double the exemption for Washington state purposes. Portability does not help you out. So you really would have needed this credit shelter type trust to double the exemption for the Washington state estate tax. So that's a quick 15-minute summary of the extensions of the fiscal cliff legislation. As I said, there's a lot more. Happy to take any questions, either now or for a few minutes afterwards. Pete.
Bob, in general, how did you feel Congress did on what they did? The fiscal cliff, so rapidly approaching the panic mode, and this stuff that just had to be done, or how do you grade what they did